Alright, so this will be the last chapter in lesson 2 before moving to the final lesson, which is lesson 3. Right, so in this chapter we will go through price cycle. I know that you asking yourself this question: why is this cycle so important? You might wonder, right? So this cycle is usually how the market deliver price. You'll discover that after every range, which which is consolidation, there's a break or expansion, then a pullback, retracement, then a reversal that continues in the direction in which it has broken out, right? So, however, you must also understand that each of these phases occur and serves a reason, and I advise you to write them down. So we have consolidation, we have expansion, we have retracement, and then lastly we have what? Reversal. These are 4 phases in price cycle that you must master, right? So number 1, we have consolidation. Number 2, we have expansion. Number 3, we have retracement. And number 4, we have reversal. So I'll point out and explain each one of them, right? So consolidation is simply what? Distribution of orders, like, right, where the market is just moving sideways. And then number 2, we have expansion, right? Expansion is simply impulse move out of that consolidation phase, which leaves us what? Which leaves us imbalance, right? And then we all know that when the market leaves imbalance, it must come back to do what? To fill in that imbalance, right? And then number 3, we have retracement. Retracement is the one that is responsible to do what? To fill in any imbalance, right, that has been created on the expansion phase. So lastly, we have what? We have reversal. Reversal simply means what? The market seeks to take liquidity there, right? So when the market reverses, it takes out liquidity, right? Yeah. So right here we have our bearish example, right? So we're gonna quickly go through it. Number 1, we have the consolidation phase. The market was just moving sideways, right? And then number 2, we have this expansion. The market broke out of the consolidation phase, right? After that, we can notice that the market has left what? Imbalance, while it expanded to the downside, right? And then number 3, we have retracement, which is pullback to fill in what? To fill in the imbalance that was created on the expansion, right? After the market fills in that imbalance, it will mitigate the order block that has been left on the expansion, right? The order block that was left on the expansion will be the one that gives us what? The reversal. So reversal seeks to take out what? Resting liquidity, right? Or equal lows, or any liquidity that will be resting while the market, after the market retraced, right? When the market reverses, the market will take out that liquidity there. This is the part of the video where we'll be going through live chart examples. So right now we can already see that we have our consolidation here. Let me mark it out. We have our consolidation. The market was just ranging at this point, right? And then this is where we got our break out of the consolidation phase, right? And then this was our consolidation, and then our expansion is here. Now notice that the market has left what? An imbalance here. right? And then we all know that when the market leaves imbalances, the market must come back and do what? And fill the imbalance and the imbalance, right? And then we can already identify this order block right here that was responsible for what? For this break of structure. We mark it out. After marking it out, we have what? We have retracement to do what? To fill in this imbalance, right? And the market came back all the way to our order block, and then we got our reversal there. That's how it works, right? So at this point is our bearish example. I'll try to go through the bullish example as well so that you don't get lost and stuff like that. You see, just always take note that the market doesn't always move smooth in these consolidation phases. So you must always visit your chart. You must always make sure that you practice to spot these consolidation phases, because sometimes you can see that the market was just moving nice right on lower time frames, but then when you go on higher time frame, you can see that it's basically your consolidation phases. You can already see that what I meant about these consolidations, right? So as we can see right here, the market was consolidating, so it is not a nice consolidation, right? It's not that clean. But then once you know where the market breaks the structure, you know that it breaks out of consolidation. We can already see that the market exploded to the upside, breaking what out of the consolidation, and then left us imbalance right here and even here, right? The market came all the way down to balance price, right? So this is our order block right here at the bottom, right? The reason why let me zoom in before and show you. When you come across these indecisional candlesticks, you must always give it a room to breathe. Like for example, if you're gonna execute off these small candlesticks, you must know that you must enlarge your stop loss a bit, right? Because sometimes the market comes all the way down near the wick of that candlestick, which on brokers it will take you out due to spread, right? And then we can see that the market came all the way down to fill in price. After filling in price, what did the market do? It cleared all of this liquidity that was created during what during retracement, right? So when the market retraced, it built what? It built liquidity. And then we can see now the market mitigated our order block that was responsible for what? For breaking out of the consolidation. And then voila, this was gonna be your entry here, and then your target was gonna be where the retracement starts. So here, see, just like this, it was gonna be something like this, but then you can keep it as clean as possible if you want to, and then your stop loss can be here, right here or here, right? Could have gotten like 6% on this trade only. You see the power of this strategy, guys. You see the power of the strategy.